It's definitely don't just continue doing what you've done before. That's sort of the main message, really.
So we're going to talk about how remuneration planning should be changing with the new tax year just about to start and the changes in the most recent budget. So the first one, probably the most significant change to owner managed businesses, is the increase in dividend tax.
Yep, so that's going up by 2% for basic rate and high rate taxpayers from April 26 onwards. So probably a small amount when you look at the actual finite number, but obviously it's been a gradual increase over the last probably 10 years, where it was that dividends used to be far more preferential and the gaps have obviously closed. So it's an extra 2% on top of what's already gone up over the years.
Yep. So we've got 8.75% in the basic rate band going up to 10.75%. We've got 33.75%.
Yep, that's the current rate, yeah.
Going up to 35.75 in the high rate, and then additional rate unchanged.
That's right, yeah.
So keeping those the same. So I suppose what should people be considering doing now ahead of that, essentially?
So I would say towards the new year, the main bit is look at what level of remuneration you need out of the business in terms of personal cash flow requirements, and then essentially rewrite that plan from scratch based on your options available. So it may have been that you've had low salary, high dividend for years. It may have been that you've had high salary, low dividend for years, whichever way around it is. Instead of just continuing with that, just start it from scratch and say, let's compare the options. There are obviously many variables. So it may be that you might have a small workforce, you might have a big workforce. Depending on how many employees you've got, you might have already used your employment allowance, which is currently, is it 10,500 a year, I think, for the employment allowance. So depending on if you've got that available in full or in part will obviously depend on which is more preferential. It also depends on the rate of corporation tax your business pays, which could be 19%, 25% of the two main rates that you'd see. So essentially, we could look at the calculations to see which one's most preferential overall. It's definitely don't just continue doing what you've done before. That's sort of the main message, really.
Yeah, perfect. And then I suppose the other key thing there that can have a massive impact on deciding between salary and dividend is R&D, and if the work you're doing is applicable to R&D, because that can significantly swing the advice.
Yeah. So it's probably a niche area sometimes, but where it is applicable, then instead of just looking at the basic figures, which may suggest that dividends could be better, because salary would or could be included in an R&D claim, whereas dividends would not, then obviously that could unlock a significant corporation tax saving for favouring salary rather than dividend. So there are many different nuances and it can get more complicated. So you could have it where you've got a personal car and you're looking to do a new car that's electric, for example, from April, then that obviously can come into calculations. Or you could have a situation where a director's got a lot of money that they've lent to the business for capital, and you could start charging interest on that loan, which can be quite tax efficient as well. So it's not just the salary and dividends to look at. There's many more different nuances to think about as well. But essentially, start from zero and just review the position. Look at all your options available and work out what's most preferential based on your circumstances.
And then looking from an employer's perspective, changes to allowances in national insurance.
Yeah. So a lot of you will probably have heard of the last budget or the last budgets where the employers' NI went up to 15% and the threshold for the employers paying has been dropped to 5%. So obviously any changes that you have for salary will obviously affect your employer's NI bill, which we can factor into the calculations. And obviously you would want to, because it's all well and good having better personal remuneration, but the company's paying 3 times as much. So there's many variables to consider, and that one is obviously one to balance overall. And I suppose also, even if the scenarios are similar, sometimes client preference helps. So if you've got dividend option, a lot of the tax from the dividends will be paid through self-assessment, whereas if you've got salaries, the tax is primarily paid through the pay-as-you-earn code. So it may be that from a personal perspective, you prefer to pay in self-assessment, others may want to just pay as you go. So again, there's no one rule for all essentially, and you just have to look at it on its own merits.
Yeah, from a practical example, I've definitely seen two sides of that coin, and we've seen some really high earners who get paid by dividends and they're spending the money that they're earning and
to
then
pay the tax,
and then having to then vote another dividend to pay the tax, which obviously is just culminating in a bigger issue and a bigger issue. So that's where obviously planning is key, but equally the difference between the tax, depending on all these variables, is so minimal that, like I say, advice at times could be, look, if you just want comfort in knowing what your income is going to be and your tax is going to be paid on a monthly basis, there's huge benefits of switching to pay as you earn and putting the whole balance through there. So that's one side, like I say, the comfort in not having that dreaded January and July tax payment that you're not planning for. So again, can come down to the individual. Second example is just cash flow, isn't it?
It is,
The dividend side, obviously, you have huge cash flow benefits where you're paying no tax from the company on the monthly basis. And you're making January and July payments, but like you say, they're payments on accounts and not bang aligned with when you're receiving the benefit of receiving the cash. Whilst, like you say, if you're tight on cash flow, then there is obviously huge benefits in continuing that on that dividend path until cash flow allows you to switch.
And I suppose the other one that's just come to mind, Sam, from that is, depending on the size of your company may get to a point where the company needs to pay tax and quarterly instalments. And in some cases, it may be favourable for the employer and the employee to switch to salary, because the more salary that goes through the business, the lower the profits, and it might be below the limits for the company to pay quarterly and have a cash flow disadvantage. So there are obviously two angles we need to look at, but obviously there are, dependent upon your personal scenario and what you prefer and how the business cash flow is. Obviously everybody's slightly different, so very much don't just use ChatGPT and see what that says. Look at it on its own merits.
So those are the key points. Like I say, the key thing is we're working with more and more variables going forward now, so every individual is different. So if you've got a good idea of it, make sure you consider some of these points we've discussed. If you haven't, or just want to thrash it out with someone, feel free to give us a shout.
Thank you.